Did you ever ponder what led to the banking crisis of 2024? It all started with a general sense of unease. The economic conditions were far from promising, with whispers of an imminent downturn growing louder by the day. US banks, in a bid to safeguard their interests, started holding back. They were hoarding cash, almost $3.3 trillion to be precise, a move driven by fears of an economic slump, ongoing deposit withdrawals, and stricter liquidity rules. The banking sector, which had been subdued throughout the year, received another blow when Moody's lowered the credit ratings of 10 small to mid-sized US banks and placed larger firms under review for potential downgrades. The credit rating agency was foreseeing a mild recession in early 2024, which could lead to tighter credit conditions and rising loan losses for US banks. These developments painted a grim picture, with the financial world bracing for impact. The storm clouds were gathering and the banking sector was right in the eye of the storm. A brewing storm was quite evident, wasn't it? Yet it's not just about the economy, it's also about the politics. The collapse of Silicon Valley Bank in 2023 brought to light the glaring political divide that pervades America's financial landscape. The aftermath was a tumultuous storm of blame and finger-pointing between Republicans and Democrats, each side attributing the bank's downfall to the other's policies and ideologies. Republicans pointed to the bank's socially progressive investments and government intervention, while Democrats called for more regulation and pinned the blame on the deregulatory policies of the previous administration. This hyper-politicized reaction underlines the risk that such a divide poses to the handling of future financial crises. Imagine, if you will, another financial crisis on the horizon. The government's capacity to intervene and mitigate the fallout could be severely hampered by this partisan mistrust, this inability to unite on a common course of action. This is not a far-fetched scenario. The political climate in 2023 was already tense, with the Biden administration and House Republicans at odds over raising the government's borrowing limit. The collapse of Silicon Valley Bank was primarily a result of poor management and adverse economic conditions. Yet, it became a political football, a symbol of the deep-seated political polarization that could destabilize not just the banking system but the entire economy. The bank's collapse was a clear illustration of how politics can influence financial stability. But how did the collapse of one bank lead to a full-blown banking crisis? Well, it all started with the fall of Silicon Valley Bank. This event sent shockwaves through the financial world, causing a ripple of panic that was felt by banks and their customers alike. People afraid of losing their hard-earned money started withdrawing their deposits, leading to a massive liquidity crisis. Banks that had once been overflowing with cash were suddenly left scrambling to meet the demand. This panic was not limited to just the customers. Banks themselves, now wary of the shaky ground they found themselves on, started to tighten credit conditions. Loans that were once easily approved were now subject to stringent checks and balances. This meant fewer loans, less investment, and ultimately a slowdown of the economy. The banking sector, already subdued from previous challenges, was hit hard. The credit ratings of 10 small to mid-sized US banks were lowered, and larger firms were placed under review for potential downgrades. The fear of an impending recession in early 2024 had everyone on edge. The initial collapse of Silicon Valley Bank, coupled with the subsequent panic and tightening of credit conditions, created a chain reaction. This domino effect, once set in motion, was hard to stop, and it led to a full-blown banking crisis. The collapse set a domino effect in motion, leading to a banking crisis. So, where was the government in all this, you may ask? Well, amidst the turmoil, the government was actively trying to navigate the choppy seas of the crisis. They were working, and continue to work, tirelessly to contain the fallout. But the course was far from smooth. The government's efforts were seen in attempts to stabilize the banking sector and prevent a full-blown economic slump. However, these measures were not without their critics. In particular, the question of the government's borrowing limit became a hot-button issue. Some argued that raising this limit was necessary to fund the recovery, while detractors claimed it would only lead to more debt and potentially worsen the situation. Furthermore, the government's spending policies came under scrutiny. Critics pointed fingers at these policies, blaming them for high inflation and contributing to the difficulties faced by the banks. Yet the scenario was more complex. Factors like post-pandemic supply chain disruptions played a significant role, making it hard to pin the blame solely on government policies. In the end, the government found itself in a tight spot, trying to manage a crisis while navigating a minefield of political disagreements and economic uncertainties. It's fair to say that the government's role in the crisis was, to say the least, contentious. So, what can we learn from the banking crisis of 2024? This crisis has shown us that the world of finance is not isolated from the political landscape. The political divide, with each side blaming the other, only served to exacerbate the situation. It's clear that unity in addressing such crises is crucial, but unfortunately it seems to be a scarce commodity in our hyper-politicized environment. We've also seen the domino effect in action. The collapse of Silicon Valley Bank was not an isolated incident. It sent shockwaves through the banking sector, leading to a subdued market and an atmosphere of fear and uncertainty. The role of government has been highlighted as well. The Biden administration's efforts to contain the crisis were a testament to the importance of effective crisis management. However, the administration faced significant challenges due to the political divide, which hindered efforts to address the crisis and could potentially do the same in future crises. Lastly, the banking crisis of 2024 has underscored the importance of sound economic policies. The high inflation and difficult economic conditions that led to the SVB collapse were in part a result of policy decisions. In conclusion, the banking crisis of 2024 has shown us that financial stability is not just about numbers and policies, it's also about politics, unity, and crisis management. The 2024 banking crisis is a stark reminder of the delicate balance that exists between economics and politics.